Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to do our take a look at real estate and what's going on with real estate. What's important about real estate is the real estate cycle controls the business cycle, and the business cycle is where certain assets outperform other assets. And the cycle, it's recovery phase, expansion phase, hyper supply phase, and then a recession. And what happened is this cycle is a little bit distorted, I think, with so much stimulus being released in the beginning of this expansionary phase of real estate from the medical event back in 2019, 2020. So when we look at the data and we look at inflation, we start looking at these things. What usually and typically happens during this cycle, during the recovery phase, it's a long phase. It usually lasts 8 or 10 years, somewhere on the lines of that. You get this recovery phase, and this phase probably lasts maybe like 11 years, perhaps. It's low inflation, low interest rates. And what happens is we go into a hyper supply phase at the top of the market. We produce far too many homes, and those homes flood the market. So we go into a recession and we go into the recovery phase. Those homes get worked off over time. It takes a couple of years to work all those things off. And then it goes into a recovery mode. And then we start eating through inventory. And then when the inventory runs out, that's when we go into an expansionary phase where we go above the housing starts average and we expand. They call it the expansion phase whenever it goes above the average. That cycle's more of an inflationary cycle. It's an expansion of new homes and new loans against those homes, which is a credit expansion phase. This phase is different. And I do have data going on, and I'm going to kind of describe maybe what's going to happen ahead of us so we can prepare mentally for what's going to come. They pumped all this money in the system because of the medical event. And that inflation is, I think, the driver of this, of the inflation rate through the CPI. It was that expansion of the money supply, 40% increase, roughly speaking, of the money. So that inflation was driven by the stimulus coming into the system. It was also driven by the expansion of credit of new homes coming into the system because we were slightly in an expansionary phase of real estate. But with that inflation, it's basically sold bonds off. Yields go up to a level to where that stimulus came into the system. And that stimulus coming into the system is far greater than what the housing market can support. So when interest rates come on up and the mortgage rates go up, basically they're holding down the housing market to some extent. And that is money getting into the hands of people. It's that credit expansion, money coming through the system, and they're holding that portion down because they've created so much money and basically flooded the system before it. So the response is to hold everything down with very high interest rates. And that's what created this picture behind me. All right, that's this picture where the price of real estate versus the interest rate is out in no man's land. And that anomaly, from what I'm gathering, and guys, I'm just thinking this through like I have before, is it pushed it way over here because this isn't the driver of it. The driver was the stimulus, but the driver of the stimulus may or may not have pushed real estate up here. It was probably holding the interest rates down with QE, had to some extent pushed it this high. But I also didn't think they would push mortgage rates as high as they would as quickly as they did. And I think that's why we're out in no man's land compared to history of where this is at. Now, if you look at the November housing market trends, this is the data that we've gotten recently. Price growth continues to slow, but remains in the double digits. And the way that they calculate this, much like the consumer price index, is they do it on a year-over-year basis to take into account any sort of seasonality and remove that seasonality out of the numbers. So we are still up 11% year over year. The green, yellow over the green line. And the green line's pretty far over the one before it, and definitely 2020 is way above the red line of 2019. Now, when these things start to compress, the upper line compresses with the lower line, your inflation rate from housing, I think, will compress a little bit. And I think what's coming up, and is if you were to take this November number, 415,000, you kind of go like this, and that's right at that kind of March, April timeframe. March, April timeframe, and it depends what this does. It may even go down and try to eclipse it in February, March timeframe. That means that we get the compression in the pricing of homes. And I think that's when the inflation rate, the consumer price index, may close that gap, is when this housing price really gets overlaid on top of each other. And we could see a decline in home prices on a year-over-year basis sometime in March, April, May timeframe. Now, I'm just guessing that's going to be the case because I don't know where interest rates are going to go. I don't know what type of moves the Federal Reserve is going to do. But there could be a year-over-year decline in home prices as we meet this March, April, May timeframe, somewhere in that range, where the line could come through here and eclipse it like that. Now, the question is, because we're talking about the real estate cycle and the business cycle, and what's important here is the business cycle, depending on where you're at in the business cycle, will depend on where money wants to preferentially flow. So the question here is, the stimulus money and the interest rates going up like they did that stop the housing market from increasing out in the future? Is this a pause and then we continue to go higher? I think that's the case. But in previous cycles, when you look at the end of the business cycle, you go into a, quote, hyper supply phase. That's where the inventories from new homes being built come onto the markets, and they flood the markets to an inventory level that's above 10 months, maybe even up to 12 months of inventory. It happened in the late 70s, early 80s. We went into a hyper supply phase. It happened also in the early 70s. It also happened in 2006, 7, 8. We went into a hyper supply phase. Now, when we look at the data in terms of active inventory, so if we look at active inventory here, and this is all real-time data here. So number one, we could see a inflation number go down, a disinflationary environment. March, April, May for sure is where that's going to hit. Probably not in January, but I think somewhere February, March, April, in that time frame there. If we look at, let's go down here. Oh, they don't have it on this one. What I was going to show you is the active, oh, here it is, price reduced share versus active listings count, the 50 largest metro areas. And the active listing count is where I usually go. So this is price reduced share on a year-over-year percentage points, and this is your active listing count. As your active listing count goes up, you can see that your price reduced share also goes up. So there's a strong correlation between active listing count percent increase and your price reduced share increase. But we're still at very low total levels. Now, I've pulled up the weekly housing report. Your active listings is definitely up 53%. Time on the market is moving a little bit slower, but these aren't horrible inventory numbers. They're up large on a percentage basis, but we are coming from a very low inventory level. New listings is also falling off a cliff, down 17%. So the inventory levels, I think, are at around 4 months. 4 months. And 4 months is a very low level. So what's happening here is a very interesting dynamic. And I don't know if we've seen this before in history. We've ramped into a strong housing market, interest rates rapidly, based off of inflation that was fictitiously created from the consumer price index, or from the stimulus in the system. that had an impact on the consumer price index of inflation. So big stimulus pump in the beginning. They raised rates as quickly as they could to basically stop and hold down inflation. They flooded the markets with strategic petroleum reserve release. Basically, they did everything anti-inflationary that they could within their control. And that's how they're managing the market at this time. The question I have is, if the forces are still there, they can only slow this thing down if they hold rates up and they pump the system with SPR and do lockdowns over in China or something like that. That's how you can control all this. But it will unwind if interest rates come back down. And I don't know if he can bring them back down substantially because it'll kick the housing starts way back up. I think he'll do that after inflation is what he is perceived to be controlled. And I think that will come sometime early next year, 2023, in that February, March, April timeframe. That timeframe is when we see the housing price was elevated during that timeframe in March, April, May. So I think that the CPI will probably slow down somewhere in this timeframe here in early 2023, because this number at 415 will eclipse it somewhere in here. So I think the housing factor may go away if they use the house prices. Now, rent prices, I don't know what they're necessarily doing. I didn't look at rent prices, but some areas are still very high. Some have, I think, cooled off a little bit. But rents are now, there's going to be a lot of pressure on rent because people aren't going to be buying homes, and there's going to be a larger demand for rent. But I do think that they'll cool off a little bit. So those numbers may cool off. They may say, oh, you know what, we'll lower interest rates and kick back on the housing market and see what is going to kick on from that market there. I don't think this is a 2006, 7, 8 scenario, or even late 70s, 1980, or early 80s, I should say, or in the 70s when we had that recession as well, mid 70s. We don't have the housing inventory. But, you know, we'll see where interest rates go. We'll see where inventory levels go. I'm not in the panic crash camp like some people are. I don't think we have the foreclosure underwater pressures. But hey, if someone has data, put it in the comments section if you've got data saying otherwise with the foreclosures and stuff, because I don't see delinquencies rising. I don't see some of these other numbers necessarily going up off the data of Fred. So I think that we're in an expansionary phase. And what's important is to understand where we are in this phase. That's what is so important. This is what's driving all of these decisions of humans. If the housing starts kick back up, and we obviously understand that commodities are very well underinvested. They have not put investments in commodities, and we don't have the mines out there. So there's going to be a large inflationary push from that aspect if money is in the system. So what they're trying to do is they're trying to control the amount of money, M2 money supply in the system, and the velocity that goes through that system. That is what they're trying to control, and they're trying to control the consumer price index, which is inflation. They're running out of ammo to some degree because they hit the strategic petroleum reserve release button to hold that down. That is a major contributor to the consumer price index inflation. They raised rates quickly to hold the housing market down, which it'll be all right for a little while. That will go away. The inflationary, quote, read or pressure in that will go away. I think come, early to mid 2023. So that's what they're using. But the problem is if you keep those interest rates high, they get themselves in a pinch because when the debt rolls over, they're going to have to pay higher interest payments on the debt that rolls over and the new debt that gets released. So that is also going to be inflationary if they have to cover that with newly printed money. We also have inflationary pressures from the baby boomers collecting on Social Security, Medicare, Medicaid, and all that stuff. And it's going to be paid out at higher rates, which also puts them into a deficit now with the number and the amount. that the people are collecting. So that's basically what I'm seeing in the markets right now. And that's what I'm trying to watch, is where we are in this cycle. Now, I think that we're in an expansionary phase. I think we're pausing the expansionary phase, and I think it will kick back on. That's my take on it right now. If we see the housing starts dive, that's when I will worry. And the cycle here, if you were to look at the cycle, and I think some people misunderstand the cycle, but this is the way that I understand the cycle. When we go into an expansionary phase, house prices, interest rates, commodities, precious metals kind of all rise together to some degree. They'll take their turns as they go up and over, but it happens during an increasing interest rate environment. It also happens when the rates of increase slow down and it pauses and goes sideways. That is where oil takes off, uranium takes off, and all these other investments. That's the cycle. Now, I think people are worrying that this cycle may come back down and we go back into a new cycle. And people are saying, well, that's the time to invest in commodities, is after that cycle. But if you look at history, and in history, if the cycle completes, if it completes, and it were to re-kick into a recovery phase, that recovery phase is not good investments for commodities. So it's highly important to understand where we are in this cycle and to get this somewhat right. I think that we haven't gone into a hypersupply phase. I think that interest rates are definitely slowing this down and stopping the housing market at this time. So they're being successful at that. And then we might have a pullback, but it's in an expansionary phase of real estate, which I think it'll kick back on, similarly to the early 1970s, 73, 74, where we pulled back and it went higher. That also had a demographic that dipped in that certain time frame. And we also went into a short-lived recession, recovery, expansion recession. It did a double hump. And I think that was driven by the demographic profile, like how it looked. And now the demographics are pretty good out till about 2024, 2025. So we're in the middle of an expansion phase. I think it's being held down. I think it can be moved to the right-hand side a little bit, as well as people are delaying their purchases of homes. And I think they're also delaying having kids to some degree versus previous generations. So I do think that we're in the middle of a demographic in home buying years, which we're in an expansionary phase. We're just holding it down. So I think everything will continue after a slowdown of some period here in, I would say in the short term. And I see that as a buying opportunity when these things pull back and pull back down. Now, it doesn't mean that we can't go higher. All of the fundamentals that push these things higher, they're all in place. So the way that I'm playing this, and everyone should know this, is I'm holding on through any sort of recession or dip, accumulate, and I'm going to ride it higher. Because at any time, the fundamentals still look amazingly good in oil, natural gas, uranium, all these different commodities. I don't want to be left out in case something does move on higher. But that is what I'm looking at. That's the data. That's what we should expect. A little bit lower inflation coming up. It's going to be a very inflationary move, a disinflationary move down to a higher inflationary level. And I don't know what that level is yet. It could overcorrect and then come back. That is a possibility. But that's kind of what I'm expecting here. And that's some of the data that I'm using to look at it. So if you guys need help in this commodity bull market that's coming up, definitely subscribe to the finding-value.com, the Platinum membership. Use the discount code DISCOUNT. That is the code. Put it in there and you get a little bit off on the Platinum membership monthly or the yearly. The yearly obviously gets a lot larger discount. But that's what I've got for today. If you guys like the content, give me a thumbs up. Subscribe to the channel if you haven't already. And we'll catch you later. This is Finding Value.